All right, welcome back to the program. Dr. Hassan Mahmud joins me now. He's the Director of Monetary Policy Department at the Central Bank of Nigeria. Dr. Mahmud, good to have you again. Let's get started. We have a lot to chew in the next few minutes. But let me start by asking, since the interest rate decision announcement last Tuesday, I guess, yes, what have you and your colleagues found out, especially like in your department, and in your department precisely? Have you been able to crystallize, coalesce the feedback from private sector, for example, and from other stakeholders in terms of this MPR raised to 18% will increase borrowing cost? What have you people crystallized and looking at?
Okay, thank you for having me. Well, normally before the MPC, that's what we call business or market survey, where we collect the sentiments of investors, businesses, producers. We call them PMIs, Purchasing Managers Index. Yes, to know what is the sentiment in the market, what is their perception of the impact of monetary policy, and what will they expect monetary policy to do in the periods ahead, because they price that into their current decision processes. Now, so when we have those results, we build them into monetary policy input that monetary policy members use for their decision. We've seen from there, and there's another important variable that we get from there, or parameter we get from there, we call the expected inflation index, where this group of people, investors, producers, also give a direction of where they think central bank inflation numbers will go. This inflation expectation is also built to the models for determinants of inflation. And what we see there is that that sentiment plays a major role in terms of how the inflation number behaves. Because don't forget that inflation is just a record of the prices. So when they think central bank will not be able to bring down inflation number will be high, they will need to price up so that they can improve their disposable income or their gains, profit on that business, and that will mean inflation numbers are going up, not because the goods are scarce or the supply has reduced, but because of this expectation is high. And that's why you also see central banks now, including Central Bank of Nigeria, built-in inflation, forward guidance in their analysis. So from the last MPC that we tightened to 18% to now, which is just 1 week, maybe in the money market we'll have seen the behavior of rates.
We've seen that, exactly.
Yes. OBV
and even the equity market too.
We've seen
going
that
down.
Yeah, but that will be too early to call. We'll have to look at that over the period. We still have another 8 weeks before before the next MPC, but immediately you see some reactionary behavior within the market. Rates are already picking up significantly, and that will mean cost of transaction among banks will have also gone up. So that is a signal that yes, liquidity is tight, or cost of fund is a lot higher. That will translate to other lending rates within the economy. So we're seeing it.
Yes, at the last MPC meeting, I don't know if stagflation was actually looked at. Stagflation being unemployment as well as rising unemployment rate and rising inflation rate. What is the calibration of the MPC concerning Nigeria's stagflation?
Well, we're seeing rising inflation rates in a period of declining output growth. However, our consolation is the fact that the rate of decline in GDP growth is a bit moderate. Since after COVID, that is 2021, when we came out of recession, I think.
No, we came out of recession last quarter of 2020.
2020,
yes.
Same year?
Yes, same year.
Okay, so since we got out of recession and we started posting positive growth in 2021, quarter on quarter or year on year, annualized, we've had positive growth. We've stayed around 3%. Last year or last quarter, we are looking at 2.25%, which was a decline compared to 3%. But it's also projected that 2022 we earned around 3%. So if you see that, we can say yes, output growth is declining, but not to a level where you are seeing inflation numbers going up and the economy is in recession. That's the real stagflation that we are more concerned about. So yes, it's tightening, liquidity is, cost of fund is a lot higher, credit growth is not necessarily declining sharply, because we still see some of central bank intervention playing a big role in that space. But the growth is because, you know, the central bank also came to a point that we've been looking at this growth for a long time, unemployment, and then neglecting or not giving more attention to inflation, which will eventually even wipe up the gains of the growth or the employment. Because even if you're an employer and your disposable income is declining month on month, then at the end of it, you will still not be able to meet your daily needs. So there was a shift, deliberate shift, to focus on inflation significantly, given that other monetary factors were driving inflation. So we saw that move to, you know, taming inflation being the priority, and then also by the side looking at growth. So stagflation is not really glaring now, in the sense that growth is still positive, even though declining a bit marginally, which is a global phenomenon. Some economies have actually recorded 2 consecutive quarters of negative growth, including the United States, but we've not got to that stage. So yes, inflation numbers are rising month on month, and even that, month on month, the rate of growth of inflation, like I said the last time, is still also moderating. So we see that turning out. We see that the rate hike that we're doing is also narrowing the real interest rate gap, negative real interest rate gap that we have between inflation and our MPR. So we're also narrowing that, which means that we're able to raise more resources in the domestic economy to drive further growth.
Okay, so the MPC is basically holding this pattern of raising interest rates until what happens, really? Because in the next, the last 5 meetings, interest rates have been hiked. So you're raising this pattern until what will bail the cat that will make you perhaps even reduce interest rates, that will also reduce borrowing costs. And let me also situate it this way. I would really like to know how the MPC will transition, especially this year, because I know that your posture in 2021 was that of handling a pandemic crisis to recovery. This year, I'm struggling to understand what it is, but I know there's a cost of living crisis. I know there's rising inflation against even the backdrop of other of other economies. So I'm struggling to see what your posture is vis-a-vis what I asked you earlier, that you're holding this pattern until waiting go happen.
Two major factors are driving this tightening policy stance. One, we've realized that post-COVID, given the injections that we did, given the stimulus packages, fiscal and stuff, aggregate demand built up substantially without a commensurate build-up in supply, production, in economic activities. Because don't forget that during the COVID, at least that 2 years, there were no production globally and including domestic. You know, because of the infection, people were closing shops, factories were closing down, workers cannot go to work, flights were not moving, so many things. So, but then we're still giving, you know, a lot of money into the system. The United States did about 25–27% of their GDP as stimulus packages. Other economies did up to 40%. Nigeria maybe did 5–6%. A substantial part of that coming in from the fiscal and monetary authorities. Central bank did close to 12 trillion. So you see a build-up in that economic sustainability plan. Billions or trillions of naira went into that space. So that elevated what we call aggregate demand. Because supply was not meeting up with that, we started seeing that pulling inflation, demand pull inflation. And what we did, and every economy in the world did, was to reduce that pent-up demand. And the only way you can reduce that is to increase the cost of fund, so that credit growth will moderate. And when that moderates, then you start seeing a slowdown in that space. Secondly, the global economy was also in a period of runaway inflation. The countries that we partner with, that we trade with, were also recording high inflation. So you have a component, since we still have some exposure to the international economy, we still have some component of imported inflation coming in. We have issues around capital outflows because of the widening negative real interest rate gap. So we had those factors to deal with. So there was a need to tighten. And when your question in terms of when do you hold fire, or when do you stop, that would depend on, we have a threshold of where we think inflation is not inimical to growth, it's not damaging to growth. When we get to that level, or when we're close to that level, we will start slowing down. Or when we see that the tightening is also impacting more negatively on output growth, we will start slowing down, looking at alternative measures.
My next interview with you, I hope God helps me, and I will ask you what that threshold will be.
Okay.
Because
I will give you the number.
There's no time for that right now. I was actually laughing earlier when you were talking about situating the Nigerian, what you guys are doing here with what other people are doing, and I was like, all the central bankers are just behaving like teenagers this period. Just like I did.
It's like that. It's a bandwagon
Yes,
effect.
it's a bandwagon effect. Thank you very much. I will have you some other time. Thank you very much, Dr. Mahmud, for coming.
Thank you very much for having me.
All right, I've been speaking with Dr. Hassan Mahmud, the Director of Monetary Policy Department at the Central Bank of Nigeria. Monetary policy issues in Nigeria, so much to unpack, really. It's like an economics class, live on television. All right, be the best you can be the change that you want to see. I am Nancy Naji. Bye for now.